Hello everyone, welcome to our Business Education and Research channel. In this video, we'll explore how balanced mutual funds can serve as cornerstone in diversifying your investment portfolio by combining the growth potential of stocks with the stability of bonds. Perfect for moderate risk investors. This session will equip you with the knowledge to select the best balanced funds for your financial goals. Understanding the balanced mutual funds. Definition and function. Balanced mutual funds, also known as hybrid funds, invest in both equities and fixed income securities to strike a balance between risk and return. This dual approach allows these funds to aim for growth through equities while seeking to cushion the volatility through the stability provided by bonds. They are particularly suited for investors who might be intimidated by the higher risk of pure equity funds but are looking for better returns than those typically offered by fixed income securities. Investor profile. These funds are tailored for investors with a moderate risk appetite, those who need a mix of income and capital appreciation but are cautious about the volatility of the stock market. Balanced funds are a strategic choice for these approaching retirement who wish to reduce risk in their investment portfolio or young investors seeking a conservative start in mutual fund investment. For example, the HDFC Balanced Advantage funds invest approximately 70% in equities and 30% in debt instruments, aiming to capitalize on the growth of equities while using bonds to reduce overall portfolio volatility. Benefits of investing in balanced mutual funds. Diversification. One of the core strengths of balanced funds is their inherent diversification. By holding both stocks and bonds, these funds spread out potential risk associated with market fluctuations. This diversification helps in reducing the volatility of the portfolio, as the negative performance of the assets class can be balanced by positive performance of the other. Automatic rebalancing. Balanced funds are automatically adjust their holdings between stocks and bonds to maintain a fixed allocation, which relieves investors from the need to manually rebalance their portfolios. This automatic rebalancing helps in maintaining a consistent risk profile over time despite market fluctuations. For example, the ICICI Prudential Balanced Fund frequently adjusts its equity debt ratio to optimize returns against current market conditions, ensuring the fund stays aligned with its strategic investment goals. Criteria for fund selection. Performance track record. When selecting a balanced fund, it is important to review its performance across various market cycles. This review helps in understanding how the fund has capitalized on market booms and weathered downturns. A fund that remains relatively stable during market volatility while capitalizing on upturns can be a prudent choice. Management team. The fund's management team is critical as their experience and decision-making skills directly impact the fund's ability to achieve its objectives. Prospective investors should look at the credentials, experience, and track record of the fund managers managing the asset allocation and stock selection. For example, the SBI Balanced Fund has consistently outperformed its benchmark over the past decade, a testament to its robust management team and sound investment strategies. Assessing risk and return. Risk tolerance alignment. Investors need to assess their own risk tolerance and compare it with the risk profile of the fund. Balanced funds, while less volatile than equity funds, still involve exposure to the stock market, which can vary widely in performance. Expected returns. While assessing funds, investors should have realistic expectations regarding returns. They should look at the long-term average returns of the funds, keeping in mind that these returns are influenced by the fluctuating nature of the markets. For example, an investor reviews the Kotak Balanced Fund's returns over the last 5 years, noting it has managed to deliver steady returns despite market volatility matching the risk appetite. The fee structures. Expense ratio. The expense ratio of a fund include all the annual operating fees that the fund charges. It is deducted from the total assets and can vary significantly among the funds. A lower expense ratio can lead to higher net savings and greater compound growth over time. Exit load. An exit load is a fee charged by the funds for withdrawal within a certain period, typically used as a discouragement for premature withdrawals. Understanding these fees is important as they can impact the returns if the investment is not held for the recommended duration. For example, the Axis Balanced Fund offers a competitive expense ratio of 1.2% and an exit load of 1% if redeemed within 1 year, favorable terms for long-term investors. Tax implications. Tax on dividend and capital gains. The tax treatment of dividends and capital gains can affect the overall attractiveness of an investment in balanced funds. In many jurisdictions, these are taxed at different rates, and understanding these can help in tax planning. Tax efficiency. Some balanced funds are structured to offer tax efficiency through lower turnover or by holding assets long enough to qualify for long-term capital gains treatment. This can significantly impact post-tax returns. For example, an investor calculates the potential tax implications of investing in the Franklin India Balanced Fund, finding that its method of handling capital gains could result in lower taxes on returns compared to other investment options. Portfolio composition. Asset allocation. The specific mix of equities and bonds in a balanced funds portfolio determines its risk and return characteristics. Investors should seek funds with assets allocations aligned with their own financial goals and risk tolerance. Quality of investments. The quality of the underlying investments in both the equity and bond components of the fund is critical. High quality investments can provide better stability and lower risk of default. For example, the DSP BlackRock Balanced Funds holds high-grade corporate bonds and blue-chip stocks, ensuring high-quality investments that align with conservative investment strategies. Investor tools and resources. Availability of information. Funds that provide transparent and comprehensive information about their holdings, performance, and strategies empower investors to make informed decisions. This transparency is a key factor in building trust and confidence. Support services. Good investor support services such as responsive customer care, detailed monthly statements, and user-friendly online portals enhance the investment experience and help investors stay informed about their investments. For example, the Aditya Birla Sun Life Balanced Fund provides an online portal with detailed analytics on portfolio performance and an active customer service team for investor enquiries. Market timing and strategic investment. Market conditions. While balanced funds mitigate some timing risk, understanding current market conditions can still provide opportunities for strategic entries and exits. For example, entering during a downtrend might allow purchasing more shares at lower prices. Investment strategy. Systematic investment plans or lump sum investments can be planned based on current market analysis and future projections. Strategies like dollar cost averaging through SIPs can reduce the risk of entering at the peak and help in accumulating assets over time. For example, an investor decides to use a systematic investment plan to invest in Tata Balanced Fund, taking advantage of market dips through regular investments, thus lowering the average cost over time. Long-term perspectives. Growth over time. The compounding of returns in balanced funds, where the income from dividends and bond interest is reinvested, can lead to significant growth over long-term horizon. This is especially beneficial for retirement planning or long-term financial goals. Compound interest. The effect of compounding becomes more pronounced over the long term as the reinvestment of earnings generates further earnings. This is a key advantage of maintaining a long-term perspective on investments. For example, by reinvesting dividends from the L&T Balanced Fund, an investor sees an exponential growth in their portfolio value over 15 years, highlighting the power of compounding. Thank you for watching our guide on balanced mutual funds. By now, you should have a solid understanding of how to evaluate and select the best balanced funds to meet your investment objectives. Remember, a well selected balanced fund can offer the perfect mix of stability and growth for your portfolio. Happy investing.